This is ET Now. You're with the India development debate. The much talked about correction is finally here. The market tanked, taking Sensex down over 1,200 points during the course of the trading day, taking cues from the global meltdown, especially the overnight rout on Wall Street. It was bloodbath on D Street, although a large part of the losses were recouped by the day's end. Interestingly, the mega sell-off coincides with the budget proposal to impose a 10% tax on long-term capital gains. The government has, however, ruled out any rollback and attributed today's crash to the dampened sentiment across the world. Top market experts also say the crash has not much to do with the LTCG tax, although it may have added to the already dampened sentiment post-budget 2018.
So what is working against the investor sentiment? Market players say investors are worried that valuations may have raced ahead of the fundamentals at a time when the American economy is showing signs of a faster revival than most had anticipated. And this could encourage foreign investors to take out their dollar investments from India. Back home, in India, there is a fear that with inflation on the rise, the central bank could turn more hawkish, although a rate hike is virtually being ruled out come tomorrow. So what are the street signs telling you? Is it the beginning of a bigger correction, or is it just a temporary blip? Buy, sell or hold? What should be the right strategy for a small investor who's made his way back to Dalal Street? That's exactly what we're discussing right here on the India Development Debate. Right here on ET Now, I'm Supriya Srinath, and with me is my colleague Sandeep Gurumurthy. Let's take you straight across to a super panel that's joining us right here on the India Development Debate tonight to discuss all of that and a lot more. Anand Narayanan, money market expert. I've got V. Anant Nageshwaran, independent consultant, Vanside Consulting. Arnab Das, head of emerging market macro, Invesco, will be joining us very shortly. I've got Ashok Wadhwa, MD and CEO, Ambit Holdings. Abhay Aima, country head and private banking group, HDFC Bank. So thanks each one of you for being with us. And Mr. Wadhwa, if I may begin with you, it really is a carnage, and I think at ET Now we've chosen to call that crash a carnage. What do you attribute this to? Is it largely driven by the global factors, the US wage data and all of that came in, which saw employment at levels of 200,000? Or do you believe that domestic factors like the LTCG tax have actually accentuated the pain that India was in any case witnessing from the world?
So I think I would say the dominant part of the meltdown that you see here is a part of the global sentiment. Clearly, world markets are seeing a bearish tendency, largely dictated by employment figures and growth figures in the US and largely in the Western world, including Europe. There's an expectation that as a result of these this new information, there will be a likely increase in interest rates, which of course will then mean that capital will fly back to the United States and to the Western world, and US bond yields will start moving upwards. I think a part of this meltdown, or a large part of this meltdown, is being determined therefore by the global factors. I cannot say that the domestic factors are not playing an important role, but the interesting thing is that domestic factors are playing somewhat of a bearish role, largely driven by the long-term capital gains tax, at a time when the economy in general and corporate earnings in specific are showing a very positive development. I would therefore like to believe that the impact of the long-term capital gains tax on the market, which is certainly a part of the reason why the meltdown is happening in India, is perhaps on the lower side and perhaps temporary. As more and more corporate earnings come out, and in particular corporate earnings for this quarter come out, the January-March quarter come out, perhaps the impact of the long-term capital gains will go back into a shadow, and the reality of better corporate earnings supported by better GDP data will perhaps override that, and we may see a more bullish trend in India after that.
Abhay, do you agree with Ashok there on the fact that this is largely driven by obviously global factors and domestic factors, really including the controversial long-term capital gains tax, haven't had too much of a role to play in this massive crash that we've seen in our equity markets?
See, markets react to news depending upon where the markets are. So first you have to take into consideration the fact that we had seen a rally from 10,000 to 11,000, almost like a vertical line if you see the graph. So that is the first thing one has to keep in mind. Same kind of news at 10,000 will have a different impact, at 11,000 will have a different impact. That's very important when you take reactions as to how the market reacts. So the fact was that this was a rally which was very steep and unsustainable at that steep kind of a rise. Then of course, I think the sentiment to begin with got disturbed by the fact that not that it was a catastrophe, but and especially with the grandfathering coming in, actually speaking, the actual impact on long-term capital gains immediately would be not much. It's only over appreciation that you would be paying long-term capital gains. Now you are way below the January 31st levels. So long-term capital gains as of now really won't have that much of an impact. But yes, sentiment, it did change. Coupled with that, also what happened was you had an international problem, and in terms of the markets reacting very sharply. So it's not only in India this has happened, and that obviously has an impact. So a number of things put together.
All right, Anand Narayan, I'm going to come to you because the question really is, has the economic outlook in the US and around the world changed sufficiently to justify weaker stock prices that we are seeing?
Well, Supriya, I think as Abhay was saying, we've got to put things in context. We've obviously seen a large run up in asset prices across the globe, and the whole paradigm that has been built out is that we are now in this golden age where growth is going up across the globe, including in developed markets, and particularly in developed markets, the US, Europe and Japan. And inflation is going to remain low for a long time. That was the paradigm on the basis of which price earnings ratios across countries and across nations went up to the current levels. Now, what we are seeing over the last few weeks, and particularly with the non-farm payroll data and the hourly earnings data of Friday, is a questioning of that particular paradigm. Are we really in a situation where we can enjoy high growth, 3.9% annual growth is the IMF estimate for this year, along with record low inflation continuing forever? That paradigm is being questioned, and rightly so. And it does seem going forward that with unemployment remaining at very low levels, we will see wage inflation creep up. With asset prices being where they are, we will see wealth effect kick in and inflation pick up. So there is a re-rating happening of the inflation expectations. Now, as that happens, you can't have the sustainable, you can't have the current price earnings level being sustained across the globe. And the same thing is being played out both globally as well as in India. So what you're seeing is a re-rating of asset prices, particularly equity prices, with the incoming data suggesting that inflation is no longer going to be can no longer be taken for granted. So while it's a correction, it still is a correction. It's not changing the the outlook for global growth. I think it's still a pretty benign world as things stand, except we are being more realistic right now. In a way, I think it's a healthy correction, because there's been a lot of liquidity which has flowed into the asset markets and driven up prices where they are, including in India. Now, last year in 2017, we saw the equity AUM in mutual funds go up by 3 lakh crores. We saw the AUM of balanced funds go up by 1 lakh crore. 4 lakh crores across equity and balanced funds. This is unheard of kind of liquidity flowing in. Clearly, some sanity has to come back, and what we are seeing is that a reflection of that. So fundamentals may not have changed, but inflation expectations are being re-rated. The possibility that rate hikes, that removal of liquidity accommodation will happen is being built into the markets. Also, I think it's a reflection of the fact that the US, by adopting fiscal loosening policy at this point in time through tax cuts, is probably going down the wrong path, and that's the only worrying sign really in the global markets. Otherwise, it's a correction.
Anand, I mean, just to keep it very simple for our viewers tuning in, what you're saying is that the markets were betting on stable inflation and recovering growth, and now we're looking at a situation where inflation is going to go up, global inflation is going to go up along with recovering growth, and that is what has upset the calculations. Is that, am I being too simplistic by saying that, or is that the fair assessment of what's going on?
That's a very nice and succinct way of putting the whole equation, except the two are related. As you re-rate inflation expectations, your growth expectations might come down, but you will find a balance somewhere, and the two will adjust with each other in a nice, virtuous way.
I have no idea what to. Right. Okay, Ashok, I must come to you. So we've talked about very simplistic solutions for people who are joining us. Perhaps the inflation growth dynamic was misjudged by the world community. But Ashok Wadhwa, which way do you see fund flows moving? Away from equities to fixed incomes, or away from emerging markets to the developed economies?
Unfortunately for India, perhaps both ways. To begin with, as bond yields start becoming firm, and interest rates start rising in the Western world, you will see a natural shift from equities to the bond market across all jurisdictions. Having said that, when there is a situation like this, the worst hit and the most to suffer are equity capital markets in emerging market situations, because emerging markets even today are seen as relatively higher risk, and therefore flight of capital first begins from equity in emerging markets largely towards fixed income in more developed markets. So unfortunately for emerging markets, it's a double whammy.
Arnab Das Johnson from London as well. Arnab, thanks for joining us here at ET Now. Simple question is, what we're seeing around the world, is this a reversal of the Trump trade or a big correction that was long overdue that's now happening? How do you read this correction that's happening in global equities?
Well, I think it's a correction that reflects the adjustment the market has to go through, because it really got over its skis, so to speak, in January. Right, we had a very bullish, maybe way too bullish start to the year across risky assets and a number of risk-free assets as well. And then we had, as you know, on Friday we had an upside reading on wage performance in the U.S. payrolls data, and so of course the market is quite concerned that there is some latent inflationary pressure that's going to come through, and this was a signal of just that starting to happen, and maybe translating in due course into faster inflation, faster wage growth, eventually faster inflation, eventually a faster tightening process from the Fed, and maybe a change in the reaction function. In which there's much more hawkishness than had been expected in this kind of Goldilocks world that we've been living through, right? So in that kind of a scenario, if that actually materializes, then I think we have a problem for both bonds and equities, for both risky and quote-unquote risk-free assets, right, in a bit of a replay of the taper tantrum. I don't think that's where we're headed yet, but that's the risk scenario. And that's, I think, one of the things that's causing all these gyrations in the market. I think what is going on is an adjustment to a somewhat higher level of yields as the QE is wound down and as the global economy adjusts to a higher growth rate, higher wages, and a somewhat higher inflation rate. Right? I think it's important to remember there are lots of different large economies in this story that are in quite different parts of their cycle. Right? The U.S. is arguably mid to late cycle. The Eurozone is arguably early to mid cycle. China is probably mid to late cycle, maybe even late cycle, right? Because the central bank is tightening. India and many other emerging market countries are probably early cycle. So there's a great deal of divergence in the economic positions of many countries around the world, many of the large economies. But there's been a kind of unified front, at least in the major central banks, on monetary policy, which is all starting. Wow.
Right. Fair point indeed. But Abhay, if I may ask you, is it then fair to say that the era of cheap money is over in the face of renewed inflationary pressures globally? Of course, inflation is perhaps going to be higher than what most people had anticipated, and even at a faster pace. Fair to say that the era of cheap money is well behind us?
I think it's too early to say that. I mean, I don't think the era of, there was an era of cheap money. There was, relatively speaking, choices were limited. So I guess to some extent that scenario still continues, but it's not as if something has, even internationally, as if something has happened overnight, that it warranted such a huge crash. But as I said, every news has to be seen in context of where the market is. Like I said before, the same kind of news at a different level in the market will have a different impact, and at a different, depending upon what the positions are, depending upon how much profit people are in, all those factors come into play if you are looking at the market in the short term.
Coming on that point, Anant, the fact that, and I know we've been talking about how the era of cheap money is over now, probably for the last 2 years. But the fact is that there are clear signs of the fact that there's going to be this, global, monetary tightening curve that's going to kick in with the Fed taking the lead, and the market has probably completely not been able to anticipate the extent of rate hikes by the Fed and by other central banks around the world, including India, which is now from, 2 quarters back, we were talking of monetary accommodation. Now, people are talking more in terms of monetary tightening. So is that the key concern now?
So I was saying there is a difference in the kind of rate hikes and tightening that you're seeing globally vis-a-vis the what you're seeing within India. What you're seeing globally is a very high growth continues. As I said, 3.9% is the expected growth for this year globally. And in the face of that, you are seeing possibilities of inflation emerging, and therefore central banks are being forced to tighten. I think what makes India's position a little more queasy is the fact that our own situation is slightly different. Our macroeconomic tailwinds that we enjoyed for a long time now, for the last 3 years or so, are slowly turning. It's not yet gone into panic mode, but the reality is our fiscal deficit is increasing. Our current account deficit for this year will likely be the highest for the last 5 years. Our inflation trajectory is not looking great, particularly with food prices and with oil prices looking iffy. We could actually see an upward trajectory there as well. And we know that a lot of our asset markets and equities especially have been built up on the back of liquidity. So our macro is not looking that good right now. It's more of a headwind than a tailwind. So what you're seeing in terms of rates going up is not because we are having very robust growth, but because our fisc is being under question, because our macros are going to be under question. In fact, tomorrow, the RBI has no choice but to be very, very cautious given the worsening macro situation. So our situation is a bit different. It's true that our micro is looking better now. Our high frequency data, whether it's PMI, whether it's IIP, whether it's quarterly results, are looking a lot better than the previous quarters. Having said that, the macro tailwinds probably are predominating right now. So our situation of rate hikes, our situation overall is a little different from the global context.
Fair point. That's an important demarcation that you're making. But while we are talking about central banks and while we are talking about the Fed, Mr. Das, what do you anticipate will happen? I mean, there were a lot of people who thought the Fed will do gradual rate hikes. But now with the wage data and the unemployment data as that comes to fore, it looks like the hike from the Fed will not just be more frequent, it will be even higher than what has been anticipated. What does that mean for global liquidity?
I think we will have a bit of an adjustment in the global monetary environment, but I don't think it'll end up being that severe. After all, so far it's really been one print that's been out of line with the consensus, a little bit above the consensus. So it's certainly something to monitor and worry about and even reduce risk, right? I think this correction reflects more the fact that the market was very heavily overbought into the idea that we'd have this very robust growth. If anything, global growth is tracking something like 5.5% at the moment, right? Well above trend, arguably above potential, and that inflation wouldn't come back. So I think we have to adjust to the reality that things are running a little hotter than the markets had anticipated. Not necessarily that the Fed is going to go and raise rates dramatically. I think at the margin, the chances of 4 hikes this year has increased, but it's not a done deal. 3 hikes still very likely, but 4 is not yet a done deal. It's certainly pointing in that direction. But even if we get 4, we've got to remember the ECB is still expanding its balance sheet, although at a slower rate, and it will continue to do that for a while. It may accelerate the pace at which it reduces its balance sheet, but we're still many months away from several quarters away from the first ECB hike. And of course, the Bank of Japan continues to insist that it'll remain in easing mode, and that's probably correct. So I don't think we're looking at a drastic change in the monetary environment. I think we're still on course for a gradual exit. And it makes sense to have an exit because it's clear that, at least for the time being, the emergencies that these extraordinary monetary policies were designed to deal with are largely contained, right? The U.S. crisis is clearly over. The Eurozone crisis has been contained. All the countries in the Eurozone, almost all of them now, including Greece and Italy, that were under significant pressure, are all growing. And China had a near crisis, which looks to have been contained. And that's why in this supercharged monetary environment, the world economy is growing so robustly. Now, so I think that means monetary normalization. It doesn't necessarily mean drastic tightening.
You're saying this means monetary normalization, doesn't mean drastic tightening. Anantha Nageshwaran, thanks for joining us. We fixed that link with you. Again, important question to sort of understand the big picture of what's going on around the world is that we're looking at a situation where global economic growth is likely to be better than originally anticipated. The IMF has raised its forecast for global growth to 3.9%. So, and on the other hand, there are fears of rate tightening around the world. So, what if global economic prospects improve more rapidly than expectations of higher interest rate? Is that a reality that markets are not pricing in yet, you believe?
So I think the problem is IMF upgraded the global growth forecast in 2007 April as well. We should not forget that. I think they are always validating a reality that has already played out. And the question is not whether the market is pricing in the global growth recovery that is going to come. The question is, had the market priced it in too much? We don't need fundamental reasons for a massively overvalued market to correct. There may be triggers, but we should not confuse them with reasons. The reason is simply the fact that the market had gone on to become too highly overpriced for its own good. At very high altitudes, the air is thin, so you have to come down. Maybe if you want to be a little bit cynical, you can say that the Wall Street is trying to send a message to Mr. Jerome Powell not to be any different from Ellen Bernanke and Greenspan, who were extremely hypersensitive to market sentiment. So should there be a risk that Mr. Powell would rather not dance to the tune of asset markets, they wanted to probably send a message that they are the boss. That's a cynical interpretation. But I would simply argue that this stock market was ripe for a correction, whether it is long-term capital gains tax in India or everything else, those are mere triggers. We should not confuse triggers with fundamental reasons.
The market has come off 8.5% just yesterday in the US from the 26th January highs, and I think the market is trying to welcome Mr. Powell with some amount of caution and sending out a very strong message there, like Anant is pointing out there. But Ashok Wadhwa, let me bring the same point to you. A strong US economy will also push up Indian exports, which is a key lever for our growth story. I mean, of the four engines of growth, it was exports that wasn't really performing well, and of course, private sector investment. With exports picking up, it should lift our own growth story. Why are the markets not pricing that in?
Well, eventually it will get priced in. The first reaction when bond yields in the western side improve is flight of capital, and that obviously results in a meltdown in the equity markets, particularly in the emerging markets. But as both domestic data and the fact that globally the world is doing and performing better emerges, countries like India, which are export dependent, certainly are beneficiaries of that growth and upturn in the global economy. So domestic data in terms of growth in India, domestic data in terms of corporate earnings are also aided by the fact that exports are bound to see a significant upturn. And it's a combination of these factors which in my view will protect a country like India, and therefore I continue to believe that any bearish tendency at this point of time in the market is perhaps only temporary, because eventually real economy and the real industry both in India and export potential from India will dictate how the markets behave.
Indeed. Let's also take stock of where we are vis-a-vis other emerging markets. And Abhay, year to date, Indian markets have underperformed most of its EM peers. Russia, Brazil, Hong Kong, Turkey, they've all returned positive year to date, as against India, which is down significantly year to date. Does that, despite having a phenomenal January, does that explain the severity of the crash? How do you read into this?
Yeah, valuations, I think the rally was pretty sharp, especially in the last 1 month. Valuations, I think the fundamentals were just beginning to catch up. So to that extent, I think the markets had, over anticipated or over, on the positive side, overreacted. And that's how markets are. You see reactions, they don't stay exactly in tune with the fundamentals, or sometimes they overreact, sometimes they underreact. That's why markets are the way they are. I mean, if markets were perfect exactly, then there wouldn't be a market at all.
Anant, Anant Narayan, actually, you've been a big votary of how valuations have looked overstretched. Is it fair to say, and perhaps that's the only positive I can look at in this market carnage where so much of wealth is eroded, that valuation discomfort perhaps has dissipated from Dalal Street?
Well, to correct you a bit, Supriya, I've never claimed to know where the right valuation of markets is. What I have had concerns about is the flow of liquidity into markets. If you see the amount of money which has gone into equity mutual funds in India the last year and balanced funds, so the numbers are quite stark. As I mentioned earlier, the AUM for equity funds went up by 3 lakh crores last year. For balanced funds went up by 1 lakh crore. And income funds saw only an inflow of 60,000 crores. And by the way, income funds the previous year in 2016 saw 1,90,000 crores of inflow. So clearly there's been a lot of money flowing into equities for a variety of reasons. The fact that it's tax beneficial, the fact that the growth has been phenomenal, and make no mistake, people who've put in money through SIPs, etc. the last year have made money. It's been a very decent, healthy return. But then the question comes, how much of the prices that you see on screen are on the back of this liquidity coming in, and how much of it is really warranted? It's nice to concoct a story which justifies valuations after the money has flowed in. Anybody can do that. So that part has looked a little unhealthy, and given that so much of retail money has flowed in, I think a correction of this nature is healthy. It does bring into sharp focus the fact that equity markets are risky. That doesn't mean that we shouldn't be investing in them, but people should have their eyes open in doing that. But in the same breath, which is why I like the LTCG as well. Now, I know it's not a popular thing to say right now in equity markets, but the moment the government starts to say that one part of the market is a better place than the other, that go into equities, I won't tax you for capital gains, go into debt and I will tax you, go into bank deposits, by the way, and I'll tax you heavily, that doesn't kind of make sense. All asset classes have different risk characteristics. Investors should be guided by these risk characteristics and their risk appetite rather than by tax alone. Now, in the past, we had a justification for trying to give a fillip to Indian capital markets. But once your AUMs for mutual funds have gone up to 22 lakh crores, do we still require these kind of incentives? So to that extent, I think putting in LTCG and this particular correction that we're seeing in equity markets is healthy. It will bring a little more sanity into flows into the markets. And hopefully in the long run, people will all benefit.
Mm-hmm. Well, what we do know is that both the Anants on the panel this evening have been in favor of the imposition of long-term capital gains tax, even though markets have not taken it too well. So let me ask this to Ashok Wadhwa before I go to Anand Nageshwan, who of course made a strong case for LTCG on this very show exactly a week ago. But Ashok Wadhwa, tell us, what about the long-term capital gains taxes upset the market so much? The fact is that the government, many would argue, has been pretty non-disruptive in introduction of the long-term capital gains tax by introducing, with the grandfathering clause. So what has upset the markets? Is it the fact that it is not set off against the securities transaction tax, or is it the signal that 10% perhaps is just the beginning and there's more to come in subsequent years? What has upset the market so much?
I think the first thing that has upset the market is it has disturbed the apple cart. There was general belief that with the markets doing as well as they are, and with the government's own dependence on the market for privatization and selling securities of public sector enterprises, it is very unlikely. I know there was some talk about it, I know there was debate about it, I know there was discussion around it, but when reality hits you on something that has been accepted and acknowledged as somewhat of a permanent part of your legislation, I think it disturbs the apple cart. So the emotion itself, I think, was to begin with the first reaction, the negative emotion. I guess once you've digested it, then you start analyzing what the real impact of the change in legislation is. And there you're right. The fact that we are perhaps the only country that has both STT and long-term capital gains tax, and the fact that in the speech somewhere there was a touch about we're beginning with a 10%, or at least that's how people interpreted it, even if our finance minister did not state it, leads people to believe that this may just be the beginning, and government may look at this as low-hanging fruit to collect more taxes. Personally, I do not believe that's what is going to happen. Personally, I believe that 10% long-term capital gains tax is a way for the government to basically dictate that there is going to be no income other than, of course, farm income, which will remain untaxed in this country. I personally don't think that the government did it purely because the government wanted more taxes, and therefore the risk that government will keep increasing this rate on a regular basis, in my view, is quite low.
All right, so that risk is low, but the fact that the apple cart has been toppled or disturbed to a certain extent is perhaps what has upset the markets. Anant Nageshwaran, you agree with that? Are you surprised with the market reaction to LTCG? Of course, this is partly LTCG, partly global, but are you surprised with that? And do you agree that yes, the apple cart has been indeed toppled, and the markets were expecting, given the government's own dependence on markets for all the divestment that they intend doing this year, they perhaps wouldn't have done this, and they've been caught by surprise?
No, I don't think so. I think anybody who has had even a modicum of exposure to sentiments and markets, what they like, they just want free lunch all the time, and they want even cash returns without risk. That is what most investors are looking for, whether it is in India or elsewhere. That is unfortunately the reality, no matter how much they learn in their portfolio management classes. But the fact, therefore, I think if you are exposed to that, then you should be aware that the market wouldn't take it lightly. But I think if India is a market that has delivered good long-term returns, and it has, then I think one should be willing to see through these short-term market reactions. And secondly, as I mentioned earlier, we should not confuse triggers with fundamental reasons. These markets, including India, were ripe and overdue for a correction, if I may even say, even ripe for a crash. So I think it is no point in blaming long-term capital gains tax. If it was not that, it would be something else. So I don't think one should be dancing to the tune of the financial markets, and that is what monetary policy in the US has done all these 30 years, and I think that is what is going to create further trouble down the road. So I don't think we should be pandering to incomes of particular stream than some other stream. As Anand Narayan very eloquently pointed out, if tax on labor income is taxed, there is no reason for a developing country like India not to tax income on capital. If anything, the short-term capital gains tax is too low.
I think the economic case of long-term capital gains tax has been argued and articulated eloquently by you and Anand. But let's try to understand the reaction. And Arnab Das, since you have a pulse of the foreign investor community, what's your own sense on how they're reading it? Did they not see this coming? Were they expecting that the government would only increase the holding period from 1 to 2 or maybe to 3 years? Did it sort of catch them by surprise? Because there's been a lot of talk about it for the last 2 years. You know, the Prime Minister of this country made a pretty emphatic statement a year ago saying that he believes that market participants need to contribute more to nation building in terms of the tax contribution. So it's not as if this has come out of thin air.
No, that's true, and I think people are concerned about the budget and the repeated policy shocks that have occurred that have hit the economy and that have maybe worsened the fiscal position beyond where it would otherwise be. Those are cyclical issues, and then there is this structural problem that the budget deficit needs to be reined in, particularly if there's going to be more of a social safety net and more of a redistributive policy, for which there are undoubtedly very good arguments. So I think these issues have been in the air, they have been flagged, but nevertheless, they were, I suppose, a bit of a surprise in the international market, and it has to be recognized that some countries have these sorts of taxes, other countries don't, and some, of course, have higher or lower taxes. So that makes a difference to the flow of funds around the world. What's done with the tax, whether it's a surprise or not, will ultimately make some difference to the equity risk premium in the country in question, and affect the relative rates of return around the world. So international investors will naturally have to respond to that. But I think what we're experiencing here and now is really not about the domestic issues or this or that policy change, a slightly wider budget deficit than otherwise in India, the long-term capital gains tax, or other aspects of the budget, but a potential shift in the international monetary environment. For which the market, as I say, I can't emphasize enough. I think, the market had really gotten over its skis in thinking that Goldilocks translated into higher and higher growth with very low inflation. Right? The monetary environment needs to be changed because the emergency is over. And I would suggest that that actually may extend the cycle, because normalizing monetary policy in good time should extend the period that growth can take place without imbalances such as inflation building out of control. Right? So I think those are the main issues that are going on in the world. And that's what most foreign investors, international investors, are going to be focusing on, and trying to fit the pattern of individual changes in country policies into that overall picture.
Right. Fair point. Let me just go and talk to us about the retail investors and what has really fueled this bull run here back home in India. And Abhay Aima, the flow of household savings into the financial market that a lot of people are calling formalization or financialization of the Indian economy has ensured this bull run. Do you believe this 10% LTCG that has been introduced threatens that story, threatens the whole participation of the retail investors, the participation of household savings into the Indian markets?
No, I don't think so. Primarily because if you look at the flow of what one is very encouraged by, the flow is that most of it is coming in SIPs, and that is long-term money, because that is really asset allocation money. It's what started about 2 years back was equity was looked as an asset class and not as a speculative class. I believe till then equities in India was looked at a speculative class. When do I get in? When do I get out? Absolutely. But what we are seeing now, and the kind of money, is that I need to allocate so much, which is asset allocation. Now that has just started, and I don't think that that is going to get hampered by things like long-term capital gains or a 5% movement, because you're not looking at really 5 to 10% appreciation in that kind of money. It's 5-year, 10-year, 15-year kind of money.
One more question on long-term capital gains tax before we shift and talk about bond markets and what to expect from the central bank. And that is coming your way, Ashok Wadhwa, since you're the tax expert on the panel. The CBDT has clarified that the benefit of inflation indexation at the cost of acquisition is not going to happen. How much of an impact is that going to have? Are you disappointed with that?
Well, to begin with, it's not a disappointment, because remember, by giving you a January 31 cost increase basis, the government has pretty much protected all your historical cost and the upside that you've built in. I'm sorry. So I don't think to begin with it's a disappointment. But should this regime continue, perhaps 2, 3, 4 years down the road, when stock that is bought, say, in April of 2018 starts becoming long term and then starts getting sold, if you don't provide indexation at that point of time, I would say that it's a little harsh. I also don't see why for short term it should be available and for long term it should not be available. I have not understood the logic, other than, as I said, that for present, having grandfathered the price as on January 31 being the cost, I think the government is perfectly right in doing what they have done.
All right, let's just turn focus away from LTCG and talk about the bond markets, because that's where the real scare, the real pain lies. And Anand Narayan, if I may ask you, what is really happening in the bond markets, at least here in India? What are you making of this? What's the way forward? And one of the questions has to be that the government has cancelled its own bond auction thrice in the last 4 months. I'm presuming that isn't an encouraging sign at all.
Yeah, Supriya, it's been a horrible 5 to 6 last weeks for the Indian bond markets. It started off with the whole confusion on the increased government borrowing program for this fiscal, initially as 50,000 crores and then reduced to 20,000 crores. Then we had that dressing down from the RBI to Indian banks saying we should manage the risks, market risks better and not ask for dispensations. Third, we had our dovish chief economic advisor suddenly turn turtle and say he's no longer expecting rate cuts, and rightly so. And fourth, of course, we had the budget itself, where the fiscal deficit at 3.3% was slightly higher. You could argue that the expectations on the revenue side are slightly on the optimistic. This could spill off into food inflation depending on what they do with MSPs going forward. Of course, there's an overhang of oil prices and what happens therefore to CPI going forward. all this at a time when, the macros, as I said earlier, are turning for the worse, whether it's current account deficit, whether it's inflation and so on and so forth. So it's been a pretty bad time, and through all this, we've always worried about the demand-supply mismatch for Indian bonds going forward. The last year, we had $23 billion of FPI money in debt coming in and providing a lot of support for Indian bonds. This year, it's very unlikely we'll see any of those kind of flows. A, because we don't have limits, and B, it's a big question mark if you opened up limits. First of all, should you open up limits? And if you did, would the money come in? So given that hole is there, and given that banks are very unlikely to buy the same kind of bonds that they bought last year when they had all the demonetization money sitting with them, there is a possibility that there's a shortfall in demand. And that's what's kept the markets really on tenterhooks. I think it will eventually sort itself out. The current rates, the old 10-year bond at close to 7.8% are pretty high. You're already factoring in multiple rate hikes in both the swap curve and the bond curve as things stand currently. I think what will happen over time is we will see more money come into debt funds, into income funds, and therefore more real investors in the Indian context reorienting themselves into fixed income and therefore providing some demand. At close to 8% return, and that too with the tax benefits that come if you hold the bonds for 3 years, I think it's a decent return in this particular context. So a bit of shift from equities to debt might help restore balance and might help bring some calm to bond markets. So bond markets, I think, are going to be nervous for a while. We're going to watch tomorrow's policy very closely. But on the whole, I would think levels to invest into bonds are coming up right now.
Since you did speak about tomorrow's policy, I have to ask Anantha Nageshwar and then on his view on what he expects the central bank to do. Anantha, how quickly things have changed. 2 quarters back we were talking of the need for RBI to cut rates and be more accommodative, and now we're wondering whether are they going to hike rates? Is this going to happen in tomorrow's policy? Are they going to turn stance from neutral to hawkish? What is your own expectation on what the RBI could do and its impact on both the equity and bond markets?
I think the RBI will refrain from cutting interest rates or raising interest rates tomorrow. I think they would definitely take into consideration the beginning of the volatility in global stock markets and in India. So I think my sense is that when things are volatile, the central bank should probably not try to add to them if they cannot sort of douse them. So my sense is they wouldn't play up the deficit risks or the inflation risks just yet in tomorrow's meeting. I would expect them to strike a note of neutrality, both with respect to the action and with respect to the communication and the tone of communication. It will be balanced between a hawkish and a dovish stance. So I don't expect them to further spook the market with the aggressive talk about deficits and inflation risks. Not tomorrow. I would think that they should play it somewhat low-key tomorrow.
All right, somewhat low-key tomorrow, but let's take this across to closing questions then around the table. And Abhay, Aima, have Indian markets peaked out yet, or does this look like a correction in a bull market?
No, I think it is a correct. There's no empirical, if at all. In fact, the current evidence, whether you look at in terms of credit growth picking up, whether in terms of the bank credit growth, or as we are seeing the results, or as we are seeing consumption increasing, I think the negative impact of whatever it was of the slowdown in terms of demonetization and GST has almost been factored in the businesses. So, like I said, if the market was not at 11,000, it was at 9,500 or 10,000, maybe you would have seen a positive reaction right now. But yes, they were ahead of markets. But I think from all senses one gets, the basic fundamentals are actually picking up, and so I would not be too. I wouldn't say the market has stopped. I think this is, like you said, a correction and typical of a bull market. The corrections are steep and sharp and normally short-lived.
Arnab, what's your own sense? Is there more pain in store for global equities and for Indian equities? What should investors do during times like this? Just wait it out and wait for things to settle down? Do you sense that there's more pain?
Yes, I think there'll be some more adjustments, and I think some of them will be painful. I think, we are shifting from a regime where we had very low or negative real rates and even negative nominal rates in some countries, to an environment where cyclically growth is proving to be much stronger than had been expected. And that implies higher real yields. And higher real yields, higher nominal yields, implies a higher discount rate for all kinds of risky assets, whether that's equities or real estate or emerging markets or credit, investment grade and high yield credit, right? So there'll have to be some more adjustment as we come out of this funk that we were in with very low inflation and significant deflationary pressures. The policy response to that inevitably ended up pricing us for a kind of perfection, right? Now some more risk is coming back into the market. The market has to reprice for the risk of somewhat higher inflation, the risk of protectionism, the risk of geopolitical issues and challenges, various things that will be more complicated. So I think there'll be more adjustments and more volatility ahead. Only a few weeks ago, we'd all been complaining, what happened to the volatility, right? Volatility had collapsed. And asset prices were arguably unreasonably valued with extremely low risk premiums. So we're going through an adjustment to a much more realistic, hopefully, a much more realistic pricing environment. Now, that doesn't mean that we're going to set off a bear market. It's an adjustment that should be healthy if everything holds together. And I think it will hold together because I think the central banks are doing the right thing.
Fair point. Okay, Ashok Wadhwa, a quick last word then. What could be the trigger for an up move? It's always good to be an optimist. We are hoping there will be an up move, but what will be the trigger for that? Global economic growth that should be lifting all boats, the domestic growth story, or the earnings revival finally on Dalal Street?
I continue to believe that India's greatest strength and the best story for India from a market's perspective is India's own domestic economy, is the reform process that our government is consistently implementing, and corporate earnings which are a reflection of both the economy and the reform process. I think the government will take even more stronger measures to try and provide that support. And therefore, honestly, it's us, it's our work, it's our country, and it's our delivery of our corporate results that will eventually trigger the positive movement upwards. And I'm very confident that that's not too far away.
Indeed, on a day when markets fell 1,200 points in intraday trade, it's always good to end on an optimistic note. So, Ashok Wadhwa, Arnab Das, Anand Narayanan, Anant Nageshwaran, and of course, Abhay, Aima, thank you so much for joining in with that perspective. What's very clear from this wonderful panel is that volatility is here to stay. It's tough to say how much more pain is in store for global equities, but this is a new normal and markets will have to adjust to this new normal.
On that note, thank you very much for being with us on this edition of the India Development Debate. Keep it with ET Now. There's plenty more of news, views and analysis from people who count coming up right here.